Yeah, can the Norwalk administrator
Okay,
let
it's,
Seth Tony in?
I just started it. So if they're in the attendees list, I'm not seeing the name, but there's a 203-719-8814 phone number. Is he the one?
It must be.
I believe that's Seth, yes. Yes.
Seth, can you hear us?
Hello.
Hey,
There's Seth.
Seth.
Hi, can you guys hear me okay? It's Seth from Tony from UBS HFS.
Yes, I hear you
Can hear
fine.
you.
Yes, we can hear you.
Oh, excellent. Excellent.
There's also a
Okay,
Charles
great.
Hero. Is Charles
shall-
Hero supposed to be on?
Yes, he's a board member.
Okay. That's all I
So
see.
since Charlie and Joe have joined, it's Jim Hendrickson. Maybe we can back up and quickly approve the minutes and the one pension request. So if everyone has the material in front of them, I guess first on the minutes, Joe and Charlie, for your benefit, I made one suggested edit at the very end of the minutes from last meeting. The very last sentence should be, the affidavits are to be sent out to people in the, it says DV plan. I think that should be DB. And I'm suggesting we spell it out, defined benefit plan. Okay, and are there any other comments on the minutes?
I make a motion to approve the minutes as your change, Jim.
All right,
Seconded.
all in favor? Aye.
Aye.
Okay, minutes approved. Then we have one pension application. Jerry, if you could walk us through that quickly.
Jerry may have dropped, Jim.
Jerry, you there? All right. I'll walk us through it then. So it's Lori Colley is the applying member. She's on the Board of Ed, 13 years, 9 months of service. She's opting for regular pension, option 2 benefit. Her payout amounts are
1307.58 a month.
58.
yeah, there you go. 1307.58 a month, 15,690 a year. Anybody have any comments on that? I think everything looked in order to me.
Everything looks good. I move we approve.
Have a second?
A second.
All in favor?
Aye.
All right, pensions approved. Okay, now we can go on to the UBS presentation. Thank you.
Great. And Nick and Seth, before I turn it over to you guys, just give the board a little
Okay.
background. UBS is Norwalk's absolute return manager, and their goal is really to provide a positive return in any type of market environment. And they've been in Norwalk's portfolio since 2013. So with that, I'll turn it over to Nick and Seth. And if you guys keep it to about a half hour, we'd appreciate it. Thank you.
Okay, well, thank you very much, and good evening, everyone. This is Nick Riparish. I'm a client relationship manager with UBS Asset Management. And joining me today is Seth Tani, Senior Portfolio Specialist for Hedge Fund Solutions. And as you mentioned, we realize we have 30 minutes, so I'll turn it over to Seth for a brief update on HFS, followed by performance and outlook, and open up to questions, if that's okay.
Yep.
Okay, Seth.
Thanks, Nick. Appreciate it. And good evening, everyone. Thanks very much for your time and your continued trust in UBS. It's much appreciated. It's interesting. I sort of asked Nick in sort of prepping for the calls, like, when's the last time we met with you guys, and time just kind of runs together, and my memory isn't what it used to be. So it's been 2 years, and what a lot has happened in 1 year, let alone 2. So I know that we're a little constrained for time, but there's interesting things I think to kind of cover and unpack in the last year or so. So I'll, in terms of performance, I'll spend some time kind of recapping what was quite a dynamic 2020. and then talk a little bit about 2021, which has proved to be not short of excitement. Today's events and today's markets activity continues to underscore that. So in terms of, maybe I'll just touch on one thing in terms of the HFS business. There really hasn't been much that changed at all, really, kind of in 2020. One thing that's more topical is there's been a slight realignment within the UBS asset management business that took effect really just about 6 weeks ago, a little bit less, the 1st of April, where the multi-manager solutions business that HFS is really the primary focal point is going to realign, where we're no longer going to be a standalone business within asset management, where we were previously headed by Bill Ferry. And so now we will report into Barry Gill, who sits as head of investments for asset management. The thrust of this move is really just to kind of unlock synergies and streamline, really kind of, the investment idea flow across AM and allow us to kind of leverage off, the idea generation and sourcing that goes across the platform. What doesn't change is who's running the portfolios. Bruce Amlick remains as CIO. It's just that his reporting line, as it relates to our business, is no longer Bill Ferry, who will retain title as head of Americas. He just reports into Barry Gill now. So, but the process upon which our business sources hedge fund managers, sources ideas, engages in portfolio construction, monitoring of managers, onboarding of managers, how we look at, evaluate, manage risk, et cetera, does not change. So it's kind of more of a top line kind of UBS structure thing, but in terms of the day-to-day running of portfolios, it does not change. But I thought it was important to share that that realignment, if you will, with the team here. It's pretty recent, just in the last 6 weeks. So that is that's kind of the update from our business side, and other than that, not really much of any change. And I think that if we look back at the last sort of 12 months or so, I mean, certainly we were the scramble is sort of transitioning from being in the office, obviously like everybody else, to working from home, and has been pleasantly surprised at how well the technology held up, how well the teams and cohesiveness was really kind of strengthened through all this, and we had, I think, a pretty solid year. Certainly there were probably a number of ways to slice up 2020 out of the gates. Obviously, the worst part of it was kind of the March-April period, where from a performance standpoint, you really saw, a reasonable drawdown in the portfolio, about 4%. What was actually, maybe even better was not only that given the dislocations and in some instances really kind of the shutdown in some markets, how resilient the portfolio was. And I think that manifested itself by the fairly significant snapback in performance in the ensuing months, sort of, making your way out of that, what was a fairly modest drawdown. Also, in terms of, kind of how we're looking at the year, is how I think adaptive and flexible we try to remain in terms of how we source and onboard manage, and really be front-footed through, what was really kind of a tumultuous, as I said, market. I think macro trading managers really stood out during the most difficult times, as these managers were those that could be the most tactical across portfolios. The opportunities that presented themselves during, say, the second quarter and third quarter of 2020 tended to focus more on credit strategies. It was a strategy allocation that we tended to be fairly light, generally underweight across the board, and really sought to move more tactically and proactively into the space, as we really kind of start to sort of delineate between those sectors of the market that were going to probably do well and those sectors that were going to probably continue to be stressed, and loosely sort of bucketing them between kind of the work from home type industries and the more traditional economies that played out. So I think we were able to be, reactive in that mindset as well. And then with the broader, sort of macro tailwinds, could be fairly front-footed with respect to how we positioned ourselves in equities as well. Our tilt in terms of strategies within equities has remained to have a geographic tilt toward Asia, where we saw the opportunity set to be more robust than in Europe and the US, mostly as a function of there being less traffic, less research, hedge fund type themes, whereas maybe there are 1,000 analysts that are covering Apple stock, but for some of the top names in Greater China or the Greater Asia region, there's a lot less coverage there and a lot more opportunities to capture inefficiencies via long-short portfolio expression. So the bias or the tilt here geographically was not one where we're making a directional call on equities within the region, but more about the opportunity set for bottom-up fundamental stock picking, which I think proved out to be reasonably productive over the course of the year. I think what we were also happy about is that as you moved out of the summer and into the fall, there was the growing political uncertainty around the U.S. elections, and we saw some pretty defensive, kind of risk-off type dynamics in the markets in late September and early October. And then, post the election, we really kind of had a very dramatic shift in sentiment around the market, and this coincided. This is really kind of a confluence of having the U.S. elections in the rearview mirror, and I believe we had 3 consecutive Mondays of positive COVID-19 vaccine news that really sent the market on a moonshot with respect to a beta rally that carried on really for the balance of the year. So really a number of different dynamics, and if you were to look at the return stream, I think it's not sure what page you guys would have, but if the return stream is on page I believe 3, or the first page of your client report. If you look at the 2020 period, I mean, you see, other than the March period, very stable performance numbers that we think are consistent with what remains to be an all-weather strategy portfolio construction process. So understanding that we can't fully predict the type of investment landscape that we're going to see on the horizon, but we want to have the portfolio position really to kind of benefit from a range of environments, whether we see a risk-off environment or risk-on environment, whether we're in a lower volatility regime or a higher volatility regime. And I think we saw a little bit of everything, if you will, in 2020. And so we think the portfolio held up, fairly well. So on the entire year, the portfolio gained north of 10.5% on a net basis. I think that compares favorably with the HFRI Fund of Fund Conservative Index, which was up 6.67% for the full year. And I believe, as Sean had mentioned, in terms of absolute returns, and we're really mindful of beta exposure in this portfolio. So the life-to-date beta of this portfolio to the MSCI World Index is 0.12. So it's pretty much right on target with where we try to beta target more of our neutral mandates around the 0.1 to 0.15 measuring stick. And so we're kind of right there where we're supposed to be, and feel pretty good that that's how the portfolio is playing out. I think if you look at the sort of 4 strategy bucket representations, it'll give you a little bit more sense of that balance. Again, just for those that may not remember, we essentially sort of classify the hedge fund strategies in 4 or 5 main buckets. There's the credit income bucket. There is the equity hedge bucket. There's the relative value bucket, which largely comprises less directional strategies, and then this trading bucket that's mostly comprised of a little bit of commodities to the extent that we want to have exposure there, but largely in what are the more traditional discretionary global macro type managers, whether they're expressing ideas in developed markets or in emerging markets. And then we tend to kind of anchor portfolios such as this with a core number of maybe 2 or 3 multi-strategy managers that that we have really high conviction on and have a demonstrated long track record really to be able to extract alpha across a range of environments. So, what's interesting is that you had, if we look at credit, we had obviously, this is probably the strategy that was most impacted during 2020 in terms of, impairment or expected impairment of industries, questions around companies' ability to finance themselves, sharp risk-off dynamic in the March-April period, so spreads blowing out. So, in the first part of the year, first half of the year, this strategy was a drag on performance to the tune of about 70 basis points. And then it rallied over the course of the year to be net positive to the tune of more than 35 basis points. So nearly 100 basis point swing in terms of contribution to the portfolio. And this ties in with my earlier narrative about, us coming into the period with more of an underweight representation in the portfolio, but this allowed us to be more front-footed here and tactically allocate to the space that we thought would be really dynamic. And so there was one particular addition to this portfolio, a corporate long-short manager that we thought had really was well positioned to benefit from both long and short exposure. So having kind of positive convexity to the book, and it proved accretive, straight, right away. Where even when credit markets were retreating in the fall, heading into the elections, they were able to make money. They were able to turn the book around and have more of a longer bias post-election, and then capture upside from there. So I think it's a very interesting dynamic in the book, and certainly led us to have a pretty solid year last year. The equity hedge part of the portfolio, again, for the equity long short managers that are in this part of the book, tend to run very tight net exposure, so not a lot of directionality. And by that I mean they typically are going to have net exposures that are sort of in the 20 to 30% net exposure range at the high end. So it probably runs anywhere from net exposure neutral, where longs match off with short in terms of risk, to maybe as much as sort of 20 to 30%. Pretty solid balance there. So the book was positive for the first half of the year to the tune of about 130 basis points of gross contribution. And this is in a very up and down market. So it does give you a sense for the robustness of that allocation during a tricky period. And then when you had more of a directional type market, it's still able to produce without a lot of exposure. So you're really seeing the alpha contribution kick in there. So for the full year, really generating nearly 500 basis points of portfolio contribution. So pretty solid and representing about half of the gains for the year, but again, being mindful that the actual beta exposure to the broader equity index is pretty modest at 0.12 on a life-to-date basis. Relative value strategies, which are going to typically be the mainstay in a more neutral mandate. So sub-strategies in this space are going to include maybe primarily fixed income relative value, some merger arbitrage, some quant strategies, as well as some convertible arbitrage, cap structure arbitrage type strategies. So more think about arbitrage themes where we're looking to capture inefficiencies within markets, within curves, within sectors. So not really betting on the direction of rates or any other kind of financial instrument, but really capturing anomalies and spreads and trading around that space. And pretty decent balance over the course of the year. So I think about 200 basis points was generated the first half of the year, about a similar amount over the second half of the year, and would have been reflected maybe a little bit differently. I think the first part of the year would have been more of a focus on fixed income relative value, where particularly interest rate spreads would have blown out pretty dramatically during the March-April period at the height of kind of the market dislocations. Managers with access to balance sheet can capture the spread blowout and then term out their financing over the horizon horizon of the expected investment thesis, and then hopefully just sort of lock in those gains and ride that, that normalization that actually played out over the course of the summer. In the back half of the year, we saw some of the more convertible type managers, and you've probably seen some things about SPACs in the last 6 months or so, and SPACs would be captured within these convert managers. So what you saw that was actually provided tailwinds in this space was really a lot of financing. Some companies were able to finance, and they took advantage of the very low rates. And so there was a lot of issuance that happened in the space that tends to be very accretive for the strategy, as well as a somewhat elevated volatility regime. And managers are actually sort of able to capture these themes, and it proved beneficial to the portfolio.
Hey,
finally,
Seth.
Yes.
Seth, this is Britt Murdoch from Callan. One question on SPACs. I mean, there's been talk of legislation coming through, and if you look at kind of the more recent year-to-date activity within SPACs, it's slowed down significantly.
Yes.
Is there any opinion from UBS on SPACs going forward, and how much exposure you potentially have to them with the underlying managers?
Yeah, no, great question. So our thought on SPACs is that more, medium term, that this is more of a permanent strategy. I think that what you saw after a lot of success among institutional players the back half of last year, maybe one of the features that we've seen is, in 2021 is really a greater footprint in some markets by retail. So we saw a lot more retail presence within the SPAC community, and then that sort of, if you will, flooded the market with deals. And so I think what we're seeing now here is, the reduced enthusiasm around SPACs has to do with letting a lot of the less quality deals kind of, run their course. So a lot of money sort of came in the space, and it needs to sort of run off. But we think that it's a good structure, and an expedited structure, as you know, to bring companies public. But given that we like to be pretty opportunistic around the space, so we actually took some chips off the table after, monetizing some reasonable gains, last year. And the managers that are playing us in this space, again, similar to what we have with in other markets, particularly in trading and long short managers, we want them to be tactical. So the representation for SPAC exposure in the portfolio is most likely going to be in Tenor Opportunities Fund. So that's where the bulk of that is. And to give you a sort of a representative sense for how kind of risk has been managed, I think at the peak, they were running about 4% of the portfolio had risk at premium to SPACs. So I think it peaked at like 4%, and I believe it's around like 2.5, right now. So they have been active at trading, that space around. You do want to pick the right managers so that they're sourcing the right deals, and not chasing either poor quality deals or holding on to the deals that have appreciated pretty well. So I think sourcing and getting into trades into the SPACs that trade around trust value makes a lot more sense, obviously, because you do capture the asymmetry and the optionality that's embedded in the strategy. And so if we look at last month, I believe there were 19 sort of deals that came, and I believe 3 of them actually traded really well, where maybe they traded appreciably over trust value, and 9 traded, I think, at trust value or below. So you had a fair degree of dispersion around that. So it is important to have the right manager who understands how to source the better deals, how to trade around the premium in the book. And it's a part of what they do, but not a majority of what Tenor is doing. Having said that, there's probably some representation for SPAC exposure in some multi-strats. I don't think that Exodus Point is doing anything. So Citadel might have a piece. I know Millennium away from you, does a bit of this, but I think it's smaller. The bigger representation where we find it is going to be within our convert art managers. But your broader question about how we feel about the space, we like the space. We think that the forward-looking expectations for returns will be more muted. It's not going to be making 40-50% per annum, I think, going forward. But it should remain a pretty solid asymmetric opportunity set going forward.
Thanks.
And I think I was just sort of rounding up the trading strategies for 2020. I think the thing here is that trading strategies are generally focused around providing diversification to the portfolio. So we like to and I think have maintained a pretty good balance between developed market and emerging market managers in this space. They can pull different levers. Developed market managers tend to be a bit more tactical, whereas you'll see probably more secular themes in emerging market managers and more kind of core trades. So we want to have a balance there to sort of capture the entire landscape. But this is a space that performed really well for us as well, and really driven by the fact that they can be dynamic and move across a number of spaces. We don't tend to do a lot with managers that have a lot of equity data within the portfolio. So a lot of our macro managers, not that they don't trade equities, not that they don't make good money in equities, but I think the core skill set focus tends to be more rates and maybe currencies. So and because we think that we probably have the sourcing ability to find the sort of best of breed of long short managers within the equity hedge space. So that kind of rounds out 2020. I can talk a little bit about 2021, but let me just stop here and see if there are any questions around performance for last year.
I don't know if it's just me, but your audio was getting a little funky there in the last 30 seconds. Anybody else hearing that?
Yeah, it wasn't just you.
Okay.
Yep.
Is it still sounding on now, or?
It is, yes.
I'm not sure what happened there.
Do you want to try and redial, or is that easy to do?
I can try to redial it. If it's still breaking up, and we'll make sure you guys can hear me. So I'll hang up and redial in.
Okay, thanks.
All right, thank you.
Sorry about that, the challenges.
That's all right.
Much better.
We actually were just given permission to use Zoom fairly recently.
Is that right? Oh. Were there security concerns?
Yeah, the bank would not. Yes. And so it's just been the last several weeks or so.
Yeah,
In
we
fact, if
just
we do
switched.
use Zoom, I dial in on my iPad, actually, a personal device.
Well, we've already learned a little more about hacking in the last few days with pipelines now.
Yeah.
Looks like Seth is back.
Can you guys hear me any better now?
Much better.
Oh, excellent. Okay, great.
Sounds-
Sorry to know what
sounds
happened
good.
there. So 2021 has been an interesting year. We are trailing the benchmark this year so far. So I think the last April estimate I have is positive 1.08%, which brings our year-to-date number to about plus 93 basis points. And the HFR conservative index looked like it was up about 1.64 in April and up about 5.39 for the full year. So we're a bit behind, quite a bit behind, this year. I think what's notable for 2021, most specifically, is it's been maybe one of the more challenging periods for equity long short. So we are on a year-to-date basis probably have negative contribution from the equity sleeve of about 15 basis points. A couple things that are at work here. There has been pretty severe factor rotation that has, an impact on hedge funds, not really on the broader, long only market. Our book has tended to have a bit of a growth tilt, and we've seen value outpace growth pretty dramatically over the course of the year. And so that's been a headwind for us. I spoke earlier about a geographic tilt to Asia. That has been reasonably solid in that there hasn't been much spillover in the factor rotation space that's predominantly affected the U.S. into the Asian market. But additionally, another tilt we've had sector-wise has been within healthcare biotech. And we've ran this sort of sector tilt, if you will, for the last 2 or 3 years or so. And it has been an absolute challenge in so far this year in the healthcare space. And so, sort of I think I saw something that, the healthcare biotech market is back to levels that it was kind of pre the election. And that's sort of how far there's been kind of in kind of market dislocations in this space. And so I think that has represented most of where our underperformance has come from, thus far in 2021. I think in terms of positioning the portfolios, the idea was post the election, post the Senate runoff, we had a sense for what fiscal policy might look like, and thinking that probably would be pro-inflation, probably would make the commodity landscape pretty attractive. So we looked to make some tweaks to the book to sort of complement our geographic tilt to Asia. So we made some additions to the U.S. space in terms of generalists, where we wanted to be fairly agnostic with respect to sectors, and just sort of have the manager sort of pick where they thought the opportunities best presented themselves. We think that is really sort of, in April started to sort of gain traction after what was a difficult period. I think the other thing that was meaningful for the first quarter and contributed to our underperformance was the rate volatility. And that really sort of played havoc within our trading book, which is negative for the year through March to the tune of about 150 basis points. So that accounts for the underperformance in those two buckets, really accounts for most of our drag relative to the index. I'm not sure relative to our peers, because I think for hedge funds it's been difficult, but relative to the index. And the impact on rates has been kind of twofold. One, the backup in interest rates and the volatility in the interest rate space really kind of challenged emerging market exposure, where they tend to have a focus on being long sovereign credit, either in Latin America or in peripheral Europe. So the backup in rates and the rate volatility was kind of a double whammy, where pressuring the longs is one thing, but creating the additional volatility, increases the level of uncertainty as well. So that was a bit problematic. The backup in rates also tended to pressure what has been a pretty popular position for the last maybe 9 months or so, of being short the dollar against a range of currencies, whether they're developed market currencies such as sterling or the euro, or emerging market currencies complex across the world. So you saw pretty sharp reversals in both of those markets, tending to impact the rate side, tending to impact in terms of backup and rate impacting emerging market managers, but also the FX challenges impacting more of the developed market managers. And so those are the things that are presenting most of the headwinds, thus far. Although I did say, April seems to be a month that seems to be getting back on track. But again, given this week so far in May, I might just hold pause there for a second, so we'll see. But just wanted to give you guys a little bit of color on how 2021 is playing out, thus far. I know
Seth, have you implemented all those strategy changes you talked about a second ago, or are those being gradually implemented? Are they fully in place now?
So they're mostly in place. I think that, let me just, my screen here froze for a second. But those are mostly in place. So I think there was an idea that commodities, as I mentioned before. I'm just going to pull up, if I can here. We go.
Yeah, and while you're looking, I was kind of
So
wondering.
the commodity.
Yeah, I say
Yeah,
while
sorry,
while you're
sorry.
looking at it, I was kind of wondering also how much your thinking on inflation has changed in the last couple of months.
It's an interesting question. We just had cluster meetings this week, and I think there's a good healthy debate. I think that there is expression kind of across the board. We have managers we have managers on the platform that are thinking that maybe the opposite view from the Fed, where the Fed has more of the view that it's going to be sort of a transitory period of inflation, and they're holding steady to their expectations that we won't have rate hikes before 2023. And then there's a cohort that believes that we get an overshoot, we get quicker language around tapering of kind of asset purchases, and then there's a 12 to 18 month window between whenever we sort of get the tapering before we actually see the first rate hike. So I think it's very much TBD, and I don't think we've really sort of made a call there. I think that having the right managers makes a lot of sense. What I will say is that there were discussions about potentially trimming some of the emerging market exposure, really as a potential way to say, well, where do we potentially see kind of tail risk in the book, and that may be a place only because, or not specifically only because, but mainly because the emerging market managers tend to be a bit more secular in the positioning of the book. So they're going to be slower to move their feet. The themes that they have there tend to have longer investment horizons, and that in your portfolio is more represented by names such as Faro. So the Faro guy and Faro macro portfolios kind of fall into that bucket. Conversely, a Rocos or a Brevin and a Caxton can be much more dynamic in this space, and so we're going to rely upon them being nimble on their feet during this piece. And so I think what we've seen recently is some risk come off the table in rate space, and I think that to your question is partly a function of a little less certainty, right, in terms of where we are with rates. And I think it's more of a function of uncertainty around the back end. So a lot of the back end expression, if to some people were negative on rates, has been more on the log end. I think we've seen people move in a little bit toward the belly of the curve. And so that in addition to a general overall sort of reduction in risk, we've also seen some movement along the curve. I don't know that there's as much thought about, the front end kind of unhinging. So I think people feel a little bit more comfortable in the, with where they are and thinking the front end kind of stays rooted for now. But I think maybe if I were to say consensus for, the end of the year for the US 10-year, it's probably 2% from where we stand. It's 2% for year end.
Mm-hmm. Okay. Thanks.
And to your question also, yeah, sorry, go ahead.
Along those lines, regarding the cycle that we're in, regarding rates and inflation, the last time we had a big move in a sustainable move in commodities was quite some time ago. There's talk about stop and start there. Do you see a sustained move in commodities, or is this like a head fake?
We like commodities as opportunity set. And it'll be interesting to see kind of how we play it. So the new manager in your portfolio is Statar, and they are mostly focused on nat gas. And part of the thought around the commodity set is, the traditional kind of inflationary theme that you referenced. We think that that's interesting as an opportunity set. And again, not so much in playing directionality here, but it's going to be dynamic, right? And anybody kind of in the trading space that we're going to hire, we want them to be able to be nimble on their feet. And it's not a kind of a buy and hold strategy where we're making a call on crude or precious metals or nat gas or something like that. What has gotten more attention and that we haven't allocated to yet. But I think gets at a little bit of your question, because I think it does have correlation to inflation, is this whole notion of carbon trading, and so that is becoming something more interesting among the trading managers. I think it has maybe a little bit more focus in Europe, but also kind of California as well. And so this will potentially present itself as an interesting potentially sub-strategy within the commodity space, but our thought from here on it would be more of a directional type trade, or more of a long bias trade, where you would have the ability to either hedge or have some degree of tactical trading. But to your point, there's probably more of a consensus that is a directional trade higher from here. But we don't have that on the platform at the moment.
So you're not looking at a big cycle in that area.
Not in terms of like we're making calls on direction per se. No.
Okay.
No, I wouldn't say that. I think the jury's out on whether if I were to poll the investment team, it's probably pretty mixed about inflation is here to stay, or or the people that sort of adopt the Fed view and that this is pretty transitory. So, but what we did think is that with the new administration, that there was going to be a fiscal spend that was going to provide tailwinds to the economy that made commodities interesting and probably a little bit more volatile, which would lend itself to trading, even though there might be an upside bias. The manager in the book does have a long bias to, has had a long bias to natural gas. So but very much a trader. And it'll be interesting to sort of see, to the extent that, kind of ESG type initiatives take root, that how managers can kind of play this theme, the green theme. But, I think our view on commodities was kind of, driven in large part by, what we thought the fiscal posture would be of the Biden administration and how to take advantage of that.
How about digital currencies? When does that become an asset class more mainstream?
Great question. We spent a fair bit of time on that today, and there's a lot of work still to be done. There are some hedge funds that are starting to do a little bit in it. To the extent that they have it, it's pretty small in terms of exposure. I think that, say, for your portfolio, Symmetry is a name that has a little bit of exposure. When I say a little bit, I mean probably less than 1%. We're starting to track it in terms of our exposure reports that we get from managers, but it's something that we're spending a lot of time on. The thing is, it's just here's my view, because I'll give you my view. It sort of feels like 20 years ago when in the tech boom. And my view is there's some part of this that has permanence, but it's sort of like, is it going to be Palm with the Trio, or is it going to be the Apple with the iPhone that comes later? Is it going to be MySpace that goes away, or is it going to be Facebook, right? And then how many of these exchanges can you have and they run at the same time? I mean, you have the FANG, right? So why can't you have, Netflix, Apple, Amazon, Twitter, kind of whatever, they're all kind of running together, right? And they do different things. I think of the 30 digital coins that are out there in the marketplace now, what did I hear? 22 of them don't have like an IP code, in terms of codable process. I think the difference between, say, a Bitcoin, which has seen its market share kind of top out, it looks a little bit like 2018, I think 2017, 2018, but it sort of topped out as its market share is now sort of slipping around 50%. But it has more of the characteristics of a store of value, whereas Ethereum has apparently more sort of applications that can be embedded in the IP. So it makes it a little bit different in what you can do. It has applications that can be attached to it, where I think less so with Bitcoin. So I'm sorry, it's a very sort of roundabout way to try to answer your question. I think it's something that's here to stay. There are kind of crude ways to trade it now. I think that, one idea that we kind of talked about is like maybe digital currencies, they look like tech. You buy into a long short tech manager, and you let them make the calls on, what are the applications or software products or what have you that are going to be the winners and losers, in the next sort of digital wave, right? Because there will be winners and losers. And so the question is, like, who comes out on top? 1, 3, 5 years from now, it's hard to say. But I think it'd be more than one, right? I think people would want to have sort of diversification, and similar to what we saw with kind of tech, there'll be a clear set of leaders, and there'll people there'll be ones that sort of fall off. But and there are also challenges with some of this stuff. I mean, I think the environmental footprint around Bitcoin is going to be a challenge for how, if you will, ESG unfriendly that is. But I think it's here to stay. It just feels like early days, but the adaptation from the institutional world kind of continues. I mean, I think we saw that, was it the CFO of Bridgewater leave to go to one of these platforms recently? Was it this week? So it reminds me a little bit of kind of 20, 25 years ago when people left Wall Street to go out to Silicon Valley. So I think it stays in some form. And the continued debasement, if you will, of the dollar and other fiat currencies tends to fuel this, as people look for other places to store wealth, if you will.
Yeah, I don't know
if I helped at all there.
Yeah, that's helpful. Thanks.
Was there any other questions you had? I think I feel like I ran over time.
I just had a real quick one for going back at the very beginning. You're talking about some organizational changes. You
Yeah.
use the word synergies, which usually means cost savings, which usually means headcount reductions. Are there any reductions in the staff dedicated to this business?
There have not been any as of yet.
Do you expect some?
And if I'm going to be honest, it's above my pay grade. I don't think there's going to be any changes to the way that to the way that the investment process gets done. I mean, I think we've run a pretty lean organization from an investment perspective. We have a global footprint, with investment teams in North America, in Europe, and in Asia. So there's a lot for us to cover, a lot of managers to cover. So I don't expect there to be any rationalization, if you will, of staff from the investment process. I mean, I don't.
Okay. All right. Thanks. Anybody else have any questions? No?
I'm good.
All right. Well, thank you very much, guys. Appreciate it.
Thank you. Appreciate your time. Appreciate your trust.
We actually have
Sorry, go ahead.
Okay. Actually, I was going to say we just had a question for you folks, if that's okay.
Sure.
We were just wondering, Seth and I, what are the broader asset allocation plans that you may have or challenges that you're seeing?
Well,
if there's anything that we can do to work with
we
you.
just wrapped up a review of our asset allocations in the last couple of months. So I think we've given us some thought recently. I think like a lot of people, we're sort of, looking hard at equity versus fixed income returns and wondering where things are going. And we just have to keep reminding ourselves fixed income's there for when the markets go bad. So, but I think we've thought through it. We're not making any dramatic changes. Maybe a slight bump up on the equity side, but nothing significant. Britt, anything you'd add to that, or?
Yeah, I think, in general, most pension funds out there have to try and hit a 7% bogey at least at this point. And looking for those returns from the point where we are, given equity valuations, it's going to be a tough 5-10 years. Might be completely wrong about that, but given where interest rates are and valuations are, it's going to be tough to hit that discount rate return.
Yeah, I agree. Okay, anything else we can help you guys
If there's
with?
anything that we can be helpful with, we'd be happy to.
Okay, appreciate
And
that.
Seth, do you have anything
No, I
else?
think I'm pretty good. But I just want to say, thank you very much. Obviously, if there are any other questions that come up, that please shoot them, our way, and we'd be happy to answer them. And appreciate your time this evening. Thanks very
Great.
much.
All right,
Thank you very much,
Thank you.
guys.
Thanks,
for your
Seth.
support.
Thanks, Nick.
Thank you.
Bye
Bye-bye.
bye.
Okay. Rich, should we go to the, any comments on this after with just us here, or?
No, I think, we had a formal due diligence call with UBS in March to discuss some of the changes to the team that Seth alluded to. And if anything, their headcount has actually increased over the last few years. So we consider them a really strong absolute return manager. A lot of the managers in the portfolio are closed and have been closed for years, if not decades. So, you're getting access to some really sophisticated strategies, and it's continuing to do its job. It's got a low beta, 0.1, and they've produced a pretty consistent positive return for Norwalk over the years they've been in the portfolio.
Well, if inflation takes off and equities head south, we'll see how they do.
Agreed.
Yeah.
But they are designed to be a ballast.
Yeah.
So
I agree. Okay. Anything else? Should we move on to performance?
sure. I'm going to share my screen.
Okay.
Everybody see that okay?
Yep, got it.
Great. So, I know we discussed the March flash report last month, so I'm not going to spend a ton of time on performance. Long story short, you can see some of these returns are about as good as we're ever going to see, coming off the trough of the pandemic at the end of March last year. And now with the rollout of vaccines, the central bank stimulus, and the positive outlook, we've really seen, equities take off. I think one interesting piece that I'd highlight is the rotation out of growth and into value within the equity markets. This GDP growth trade, as we kind of bullet here, has really been accentuated this year. To give you some perspective on how much better value has outperformed growth. In the broad US market, the Russell 3000 through yesterday is up almost 18% in the value space versus 4% for the growth space. Small caps, similar story. Small cap value up over 24% year to date. Small cap growth up less than 1%. And in large caps as well, similar story. So, we saw growth outperform value for 10 years, and it seems to be rotating as we've seen cyclical sectors like energy, financials really lead the markets year to date. So that's why we have both growth and value managers in the portfolio, but it'll be interesting to see moving forward, given the stimulus and the expectations moving forward of a very strong economy in 2021, how this plays out. Turn to the asset allocation. The IPS was adopted last month, and going forward, we will have the new asset allocation. And we also plan to bring a rebalancing proposal to the June meeting, which will include, both a redemption from Blackstone, which we'll be hitting, as well as the city's contribution. So the goal would be to shore up the targets with the contributions that will be hitting the pension plan. Here we can see the old asset allocation versus target at the end of March. And given the equity run-ups, you can see some overweights to domestic and international, as well as global equity long short, and underweights to domestic fixed income and infrastructure and private equity. Showing the asset distribution here on page 15.
Rick, can you blow that up a little?
Yes, how's that?
That's better.
Total assets about 514.4 million, up, about 9 million net. You can see about 7.6 coming out and about 16.7 in investment gains. Notably from the trough of last year, you can see total assets up over 125 million at the total plan level. So pretty amazing run over the last year. All of the assets were in their respective ranges. And one note I would make is at the last meeting, the board did vote to redeem 3 million from Artisan and 2 million from Prudential, and Chitsime did submit those trades. So I think they've already hit the cash account. So she should have cash to pay benefits. In terms of performance, just wanted to highlight a few. I know LSV was in earlier this year, and values was very out of favor, to say the least, over the trailing 3-5 year periods. You can see they had a very strong quarter and a strong 1 year ended March 31st. And year to date, through earlier this week, LSV is up about 33% versus 25% for the value index. So good to see them bouncing back. And in the second quarter, they're up about 6% and about 300 basis points above the value index. So strong performance from LSV. You can see Columbus Circle, who's been an exceptional performer. They have really stabilized themselves and continued strong performance even without Cliff Fox, who left last year. So good to see from them. And you can see under developed markets and emerging markets, Silchester had a good quarter, and BlackRock Emerging Markets continues to perform well. So as Seth mentioned earlier, UBS trailing their benchmark, but longer term, certainly within expectations, and over the last 7 years, strong performance versus their benchmark. And at the total plan level, you can see for the quarter up 3.2%, well above the benchmark, and the trailing year up over 37.5% versus about 32% for the benchmark. So good to see active managers outperforming in a certainly a volatile market. And lastly, just showing the fiscal year to date numbers. Again, as almost, about 1 quarter left before the end of the fiscal year, and total equity up about 30%. You can see the U.S. equity composite up almost over 39%. So really strong returns across the board, and total plan up 21.4% fiscal year to date, well ahead of the custom benchmark. I'll pause there. Happy to answer any questions on performance.
None here. Looks good. Might be one of our best fiscal years ever.
Yeah.
Probably will be. Unless it gets wrecked in the next 6 weeks. Okay. Any questions on that from anybody?
Looks good.
We're going to take a look at OPEB.
I'm good.
I don't think we have an OPEB meeting tonight, Jim.
Oh, we don't. Okay. I know that you sent around the returns though, right?
I did, and they're also in the back of the executive summary.
Okay, that's fine. All right. Well, if we don't have an OPEB meeting, that's it. Any questions or comments? Do we have a motion to adjourn?
Motion to adjourn.
Second?
Seconded.
All in favor?
Aye.
Aye.
Good job, Jim. Thank you.
All right, thank you, guys.
Thank you,
Brett.
Thanks, everyone.
Bye, everybody.
Take care.
Nice
Maybe we'll be
job,
back
Jim.
maybe we'll be back at City Hall next month. I don't know. We'll see what Ray says.
We'll make sure that, that our president knows how good of a job he did.
Thank you.
Frank would be proud.
All right, guys. See you later.
Thanks,
Bye-bye.
guys.
Good evening.
Bye-bye.
Take care.